Let's conclude this video on corporate planning and valuation. Try to understand a little bit more about what happens what happens once we get to the end, right? What do we do with the information that we have at the end? So we have predicted future operations. That implies some kind of a change in assets. It implies as well that we may need to finance some of this growth. We could have more money than we need, rarely happens, or we could need to go outside of the company to finance further. In this example, we have calculated an internal growth rate for this company of 4.3%, but we are assuming an 11% growth rate. So that information tells us that we are going to have to go outside the company to finance. There needs to be money from outside in order for any of this growth to actually happen. So when we make this decision, it creates a bit of an issue, if you will, with doing this in Excel. Because if you, in this case, where we added a line of credit that has an interest attached to it, well, since I increased the line of credit, that increased interest, that changed net income, that changed reinvested income, right? That changes my retained earnings, which also then has an impact on that deficit or surplus. This process is what's called an iterative process. So every time we do that, there's going to be a change. And if you do this enough, what it will turn out and tell us is that every time we make a change, we'll get closer and closer and closer to no deficit or no supply or surplus, which means that we've been able to distribute this this cash flow need or surplus. We've been able to distribute it somehow through the financing. It's a little bit more involved. This is very cursory kind of view with this, but it is a process. In more detail, they refer to this as something being pro forma analysis. But what else could we do besides this line of credit issue? We could, if we cut dividends, that would increase retained earnings. That might help us. We could switch from short-term financing to long-term financing. We could decide that we want to cut back some of the growth that we think is going to happen, change our plans, figure out a way for better profitability, better management of inventory. As we did in this example, we've thought of 3 or 4 things that could have influence and help us with our planning. So again, in the end, this is a process of seeing what our initial thoughts are, making some changes, trying to find revisions, and of course, working our way through the system till we get to a point where we're fairly certain that we understand exactly what we want to do. So in this case, we had some improvements. We're going to reduce operating costs, reduce inventory, decrease the investment in plant and equipment. That's going to have changes, obviously, in our cash flows. So what does that do for us? Well, as far as improving the operating plans, what we really are interested in is knowing what happens to ROIC, but you can see that it's now 10.4%, which is obviously greater than 10%, which means now we're probably going to see an increase in value. We've changed our stock price now. Now the new intrinsic stock price with these values is now $81. a huge increase over the last time. So this improvement in value of operations went from $958 to $1,300, and it only cost us $50 worth of improvement. So I think obviously the company should make these improvements. What will happen after the fact then? How does this ultimately play out in the news statements? Well, in the end, again, we have a net income of $402 now. 110 of that is our dividends that we've planned on. But now we have some extra money, right? We have this $162. There's actually $292 left. What do we do with this money? So 162 of that can go towards paying off that line of credit. So again, here's the line of credit. We're showing 0, and we show that these net out the total assets and our total liabilities and equity. They now equal each other. And it shows in the end what happened. Our spontaneous liabilities went up 180. Our net income plus minus the regular dividend, that's that $292. That gives us our increase in financing of $472. Now, if we take 162 of that, that's the amount of surplus financing. In the end, we have a total surplus that we could pay a special dividend of $180. Again, is that something we want to do? Maybe not. But what can we do with this extra money? This, again, is all part of this question of what do you do with free cash flow? It's extra funds that we don't need today. We could repurchase stock. We could repay debt. We could repurchase or purchase some marketable securities. Again, if we have this plan for maybe 2, 3, 4, 5 years, maybe we don't need this money right now. Maybe we put it aside, but maybe next year there is a deficit. So if we put this money away today, we won't have to use it in the future. And there's lots of variations to this. The assumptions primarily above have been that all of these things are straight. They're a linear relationship. There's no a connection between a volume and the values of these ratios, but we know that none of that stuff is ever really true. There are economies of scale as you get bigger. Sometimes you need less changes in assets to maintain the growth. Sometimes things are not linear, right? It's not a straight line relationship. And quite frankly, one of the biggest things is fixed assets. I mean, typically we can't buy them in a formula, right? They're lumpy, right? So if you need $10,000 of plant and equipment, that's what your forecast says. But what if you can only buy it in $15,000 increments? So you're going to have to buy 15,000 even though you only needed 10. So there's a lot of variation. There's a lot of complexity to this planning process. The thing that's nice is that once we get an Excel spreadsheet that can help us visualize this, changing the variables and making these estimations and trying to see how our decisions impact financial statements and ratios, it actually is very simple. The challenge is getting the worksheet correct so that it accurately displays the changes that are happening in our statements. So again, a fairly complicated process, I agree, but that's planning. Planning is never straightforward. Planning always is iterative. A change in A will always make changes in probably B, C, D, and E, right? The changes in one things in a company always impact others. Hope to see you in the next video.